Hello and welcome. Thanks for joining us this morning for our Social Security webinar. I'm Whitney Roseborough, one of the marketing coordinators here at Squire. Before we get started, I'd just like to point out the Q&A section in the top right corner of your screen. Throughout the presentation, feel free to post any questions you might have there, and Nathan will get to those either throughout or at the very end. I've also shared a link if you'd like to sign up for our Squire Wealth Advisors e-newsletter. Now let me introduce you to our presenter today. Today you will be hearing from Nathan Larsen. Nathan is a CPA and wealth advisor for Squire Wealth Advisors. His focus is financial planning and tax. He enjoys helping his clients with all areas of finance and tax strategies. So take it away, Nathan.
Thanks, Whitney, and thank you everyone for logging in. Today we're going to talk a little bit about Social Security and help you understand how it works and maybe give you some ideas on when you should start receiving benefits. Before we get started in the presentation today, I did want to just highlight a few things from the Social Security Trustees Report. Social Security is a pay-as-you-go system, so workers are paying Social Security taxes on the dollars they earn now, and those dollars go into a trust fund, and the trust fund is used to pay out retired benefits to people who are retired. There is a $2.8 trillion trust fund currently, and you hear on the news all the time that the Social Security system is broken, or it's bankrupt, or it's going to run out of money. And so I just wanted to highlight a few things from that report and talk about the true status of the system and the trust fund. So if you go way back to 1950, we had 16.5 workers paying into the Social Security system per retired beneficiary. If you jump ahead to 2015, that 16.5 workers dropped down to 2.8, so a really significant drop. So 2.8 workers in 2015 for every one person receiving benefits in 2015. And if you kind of project that forward to 2035, the estimate is that it will go down even more to 2.2 workers per beneficiary. There's a few reasons for that. People are living longer now than they used to in 1950. We're not having as many births, so the birth rates are down, and there's not as many new workers replacing the people who are retiring, and the retiring people are living longer. And so the system is kind of under some stress in the long term. Now in 2020, the 2021 trustees report's always a year behind, and this is the most current data, but in 2020, the trust fund actually increased $7 billion. Some of that was payroll taxes, and then they are investing that trust fund, and so there's some interest that gets paid, and then they charge taxes on Social Security income, which we'll get into later, and so the trust fund increased $7 billion, which is a pretty small percentage of the total. With the lower number of workers per retired beneficiary, the estimates are that the trust fund will run out by 2033. And what that means is if Congress doesn't change anything in the system, worst case scenario, the estimates are that the Social Security system would be able to pay out about 76 to 75% of the benefits that it's currently paying out. So if Congress doesn't do anything, we are facing probably some benefit cuts in the future. My guess is Congress will do something, and we'll talk about some of the options towards the end here. But with that said, I'm going to jump into the material we had today. So the main question people have when they're going to retire around Social Security benefits is, when should I start taking benefits? So there's this term called full retirement age. We'll get into what that means. That's between ages 66 and 67, depending on the year you were born. You can take benefits as early as age 62. There's a benefit reduction, and we'll talk about that a little bit later. And then you also earn delayed retirement credits as long as as late as age 70. So you wouldn't want to wait past age 70, but the longer you wait, then you're earning some delayed retirement credits, which means your monthly payments are bigger. So the most important thing is to remember that there's no one size fits all answer to the claiming time frame. So based on your individual unique circumstances, that's what will determine when the optimal time for you to claim benefits is. It's a significant benefit amount. You know, a lot of people, when I look at the payouts of Social Security over their expected lifetime, there's many cases where it's over $1 million. So it's a significant portion of most people's retirement income. And if you're married, timing also affects your spousal and survivor's benefits, which is definitely something to plan for. A few things you should consider when you're deciding when to take benefits. First, you should understand when your full retirement age is, and what your benefit calculation is, and just how it works. And we'll get into those details soon. You should understand the effect of early or delayed retirement. Obviously, your life expectancy plays a big part in factoring when the best time to take benefits is. And when I think about life expectancy, I always encourage people, if they're married, to think about joint life expectancy, because even if somebody's life expectancy is lower for whatever reason, there might be a chance that your spouse has a longer life expectancy, and you definitely want to plan for that. If you're planning on, continuing to work, that factors in. Other sources of retirement income, you might be able to retire and still delay Social Security and use some of your other sources of retirement income or other savings. Income taxes, always good to plan for. And then how your spouse might be affected. So full retirement age. Remember when we started, we said that people are living longer. When Social Security was first enacted, people weren't living as long, and so they had a lower or a younger full retirement age. And the full retirement age is the age at which you would receive what Social Security calls a full unreduced benefit. And because of the issues with the lower ratio of workers to retired beneficiaries, Congress decided to change the full retirement age, basically to increase it by 1 year, and that made people mad. So they made it complicated, like most government things. They decided to incrementally increase it. So your full retirement age, depending on the year you were born, it may be 66 or 67 or somewhere in between. So you can see from this chart where yours is. And remember, that's the age at which you get a full unreduced Social Security benefit. Benefits are calculated based on your highest 35 years of earnings. So how it works, to qualify for benefits, you have to have worked in the system, either had Social Security taxes withheld from your paychecks, or if you're self-employed, paid self-employment taxes for 40 quarters. That's 10 years of work. It doesn't have to be consecutive. It's really based by quarter. So 40 quarters to qualify. Once you qualify, the calculation's based on your highest 35 years of earnings. If you don't have 35 years of earnings, they do throw in zeros to get a full 35-year average. And then if you have more than 35 years of earnings, they use your highest 35. So I'm just going to go through a little example that shows the effect of early retirement versus taking benefits at full retirement age versus taking, waiting and earning delayed retirement credits. So in our example here, our person is full retirement age is 66. Their full benefit at that age is $1,800 per month. They can start benefits as early as age 62. And basically there's an 8% reduction each year they take benefits early. So if they jump in and start right at age 62, instead of receiving $1,800 per month, they would receive $1,350 per month. that equates to a 25 to 30% reduction depending on when your full retirement age is. Of course, you'd receive benefits for a longer period of time, and so you kind of have to factor in how long you expect to live to determine when the right age would be to claim benefits. This is the same example, just going the other direction. So if you delay taking benefits, you earn what's called delayed retirement credits, which is an 8% increase per year each year you postpone. And that 8%, they credit that each month. So it's not an all or nothing. You're getting that 8% increase over, spread out over each year. But in our example, the person's full retirement age at 66 with an $1,800 monthly benefit. If they waited till 70, that benefit increases to $2,376. And you can see it's a per year increase of 8%. So across the entire spectrum from age 62 to 70, the entire range that somebody could claim benefits, if someone waits until age 70, they have a 76% increase in monthly benefits compared to age 62. They would have lost out on those 8 years of benefits, which in this example would be $130,000. But they would have bought themselves a larger monthly payment for their lifetime and potentially their spouse's lifetime. So one of the things that I always try to encourage clients to look at and think about is longevity. One of your biggest risks in retirement is outliving your assets or your savings. Meaning, you live a long time and you run out of money. We definitely don't want to have that happen. On average, a 65-year-old man, the life expectancy in the country is 83. Women, it's 85. However, there's a 1 in 4 chance that you'll live past age 90, and a 1 in 10 chance that you could live past age 95. And delaying Social Security is one option for protecting yourself against longevity. It's a form of longevity insurance, which helps to prevent you from running out of money down the road. Okay, one of the factors is working. So if you decide to take benefits early and continue to work, there is an earnings a reduction. There's a limit on how much you can work, but your Social Security benefits will be reduced, potentially reduced, if you take benefits and continue to work before your full retirement age. If you wait until your full retirement age, there's no earnings reduction. You can earn as much as you want to and still receive your full benefits. So those limits, I'm just going to put them all out here. So before your full retirement age, your benefits are reduced $1 for every $2 of earnings that are greater than $19,560. So that you can earn a little bit of income, but not much. The year you reach full retirement age, they give you a bigger earnings limit, and that's because not everybody retires at December 31st. You might retire mid-year or partway through the year sometime. And so they give you a bigger limit there, and they also reduce the benefits slower if you're over that earnings limit. And then, as mentioned, if once you reach full retirement age, there's really no issue with earnings. You can earn as much as you want to. And when I say earnings, this is earned income. So income from a job, income from a self-employed business activity. It doesn't count, investment income or rental income or anything like that. It's actual income from working. Okay, the other, probably the most important factor is when you're doing retirement planning is how are you going to replace your paycheck when you stop working? So we have Social Security. Sometimes people will reduce their work or take a different job and have job earnings. There are still some pension benefits out there that people have. By far, most people's income should and is coming from savings and investments and Social Security. Those are kind of the two biggest that I see. And depending on what types of retirement income you have, that may determine when you take benefits. I get, benefits, once you start receiving benefits, they are taxable to a certain extent. So this chart here shows the taxability of Social Security benefits. And I always get, sometimes people are upset or concerned that they have to pay taxes on Social Security. And I know that's frustrating. Nobody likes to pay taxes. If you look at your Social Security report and it shows you how much Social Security taxes you've paid over your lifetime. And then if you also kind of project out the benefits you're likely to receive over your lifetime, you're getting a way better deal than the taxes you have to pay. But when you start receiving benefits, they are taxable if your income is above these limits. So, excuse me, if your income is below 25,000 for a single person or 32,000 for a married person, then your Social Security benefits are tax-free. If your income is between those ranges, 25,000 to 34 for a single person and 32 to 44 for a married person, then 50% of the benefits you receive are taxable. And then if you're over that 34,000 for a single person or 44,000 for a married person, then 85% of your benefits are taxable. Now remember, it's not an 85% tax rate. It just means for every $100 of benefits you receive, 85 of them are taxable at your whatever tax rate that income falls when you do your tax return. And combined income in this case is your adjusted gross income plus your non-taxable income plus half of your Social Security benefit income. So it's really, it's pretty hard to stay below those limits. Most people that I work with are over. I have seen occasionally where they're under, but most of the time, if you've saved well for retirement and have any sort of other retirement income, you're probably over the threshold, and which means 85% of your benefits are taxable. Let's talk a little bit about spousal benefits. So if you're married, there's an endless amount of claiming strategies. Because you're claiming benefits on your own earnings record. You might have a spouse that's claiming benefits on their earnings record or on yours if they haven't worked much. And so the big question is, what's the appropriate combination of claiming strategies between both spouses? And spousal benefits are interesting. Remember our example of that person who was full retirement age 66, $1,800 a month benefit. If they were married, their spouse would be eligible for a 50% benefit on their earnings record. So in that $1,800 a month example, the spouse could receive $900 in addition to the worker receiving $1,800 a month. And spousal benefits are interesting because if your spouse has worked and qualified for their own benefits, then when they go to apply, they either get their own benefit or the spousal benefit, whichever is greater. They don't get both, they get the one that's bigger. And this spousal benefit's available even if somebody didn't work at all. So if you had a mother who stayed home, didn't work, raised children, they are still eligible for the spousal benefit. In order to receive the spousal benefit, the primary worker has to have claimed their own benefits. And there's one little loophole still available that, if you were born before 1954 that I'll mention. But if you're born after that, then the primary worker has to be claiming benefits in order to free up the spousal benefits. And spousal benefits don't earn delayed retirement credits. But the age of the spouse, the full retirement age of the spouse claiming spousal benefits is important, because if, in our example, the benefit would be capped at $900 a month if the spouse was at least their full retirement age. If they took benefits before their full retirement age, then there's an 8% reduction in the spousal benefits. But if they take benefits after their full retirement age, there is not an 8% increase on the spousal benefits. So they're kind of capped at that full retirement age amount. And to make it more confusing, you have to start with the primary worker's full retirement benefit. If that primary worker delayed benefits and earned delayed retirement credits, you still would start at that full retirement age benefit in calculating what the spousal benefits would be. Survivors' benefits are very important as well. So, when one spouse dies, the surviving spouse receives the greater of the two benefits. So typically that's going to be your primary earner's benefits. And you would, in our example, if we were claiming benefits at full retirement age, $1,800 a month, we were also getting a $900 a month spousal benefit. When one spouse dies, that $900 spousal benefit would stop, and whichever spouse was left would receive the $1,800 per month benefit. Survivors' benefits are payable as early as age 60 if you had a younger death or a bigger age gap in between spouses. So something to consider for sure. There used to be some more loopholes. Social Security, as we talked about earlier, has got issues, and Congress needs to make some changes to keep the system, functioning. They have made changes. Not too long ago, they took out a few of the loopholes. The file and suspend strategy is gone now. This strategy here is kind of our only loophole still left. If you're born before January 2nd, 1954, one spouse can claim their own benefits and not claim a spousal benefit. They can file it's what's called a restricted application for spousal benefits only and still let their own benefits grow. And that's still available if you are this age or older. I'm happy to run scenarios for you if you fit here, and if you don't, that's what I do, is help people individually optimize their claiming strategy so that they can get the most out of Social Security. Oh yeah, and the later. So yeah, if you do this strategy, once you take spousal benefits only, and then you let yours keep growing. And once you reach age 70, for example, then you switch to the higher one after it's grown. So you get some money, up front that you wouldn't otherwise get, and then change to the bigger amount when it's available. All right. Factors to consider if, taking benefits early. If you need Social Security income right away, you might not have the ability to delay benefits. You may want to invest your monthly benefits, although that 8% increase is a government guaranteed increase. I know there's some potential risks with Social Security, not being able to fund 100% of its payouts, but it's pretty hard to get a government guaranteed 8% return anywhere. You may want to delay having to take funds from other retirement vehicles. So taking benefits should be considered as part of a full comprehensive plan for you, a retirement and income plan. Your spouse wants to delay taking benefits. Sometimes if you have two working spouses that have similar amounts of benefits, one might want to take benefits earlier and maybe one delays, and then you've kind of hedged both options. Taking benefits later, definitely what you're basically doing is buying yourself a higher monthly income for your lifetime. And so if you think about this as the longevity insurance, it's the cheapest, best annuity out there that you don't have to pay commissions to or anything. You buy yourself a bigger monthly payment for your lifetime and your spouse's lifetime if they outlive you. That's the next bullet point there. You want to maximize survivor's income. Obviously, if you're planning to work longer, there's no need to really jump in and take benefits, especially before full retirement age, because you won't get them anyway. And so it wouldn't make sense to go in and take benefits just to have Social Security withhold them because you were earning too much. If you're able to file for spousal benefits first in that example, being born before 1954, then you may want to delay your own and take the spousal benefits. What should you do now? So you can find out what your earnings record is. If you go to ssa.gov, you can create an account, log in, check your earnings record. Social Security gives you the numbers on what you're likely to receive in the future. And I use those reports to run Social Security analysis for individual clients that need help deciding when to take Social Security and how it fits into their overall retirement plan. I'm happy to run those for anybody who's participating in our webinar today. You would just need to go get your earnings report, schedule an appointment with me. You can send those over. I can meet virtually or in person, and we can go over a specific analysis for your situation. When you're ready to take benefits, you need to apply at least 3 months before not before you reach age 62 like it says here, but before you want benefits to start. It takes some time to work through the application process. You apply online. Sometimes they'll call you back or schedule a time to call you back to go over some questions and your application. If you've got a more complicated case, you might have to schedule an appointment to go down and meet with the Social Security agent or person. There's an office in Provo and Salt Lake, and I believe they're doing most things over online and through the phone now. But yeah, apply online, by phone or in person. That's all I had prepared. I've got lots of time for questions. If people have questions about Social Security, type them in the question and answer chat, and I'll read through those and answer as many as we can over the next 10 to 15 minutes, and then you guys can be on your way and continue with your day. So thanks for attending, and I'll just be watching the Q&A section over the next 10 to 15 minutes. Okay, looks like we have, no questions yet. While you're thinking of your questions, I will go over a few of the changes Congress could make and some of the things that people have talked about. So in order to ensure that Social Security continues and is able to pay out the full amount of benefits. So some of the possible fixes, they could allow individuals to invest some of their current Social Security taxes in a personal retirement account. I kind of like this idea. However, I don't know that I trust the American people in general to save. If there was a way for them to kind of make sure that happens, it might be a good idea. But yeah, in general, Americans have a savings issue. We're not saving enough for retirement, and so the more you can save and kind of prepare yourself to retire on your own, and whatever Social Security you get is kind of bonus, that would be the best way to plan ahead for retirement. They could raise the current payroll tax. So right now, Social Security taxes are 5.3% from the employer. Actually 6.2, because some of it goes to disability. So 6.2%, the employer pays that amount, and the employee also pays that amount. I've heard that even a 1% increase in those taxes would kind of shore up the system. I'm not for tax increases, but I think if it were to enable the system to continue 1%, I could live with that, and I think most people could and would be happy to do it. that's an option. They could raise the full retirement age beyond age 67. That's probably likely to happen at some point because people are living longer. And so it would make sense to push the full retirement age out to compensate for the longer life expectancies. They could raise the ceiling on wages. So currently in 2022, Social Security taxes so you're subject to Social Security taxes on up to $147,000 of Social Security income, or of wages or self-employed income. After you reach that cap of 147, the Social Security taxes kick off. So they could raise that cap, and they have over time. I mean, last year it was like 142, and before that it was 137. So they could raise that or take it away completely, and that would help. They could reduce future benefits. Nobody likes that idea. They could change the benefit formula. That's kind of similar, reducing future benefits. They could change how they calculate annual cost of living adjustments. The real issue is nobody wants to make the changes in Congress because it means that we have to go through some pain, and nobody's willing to do that because they want to get reelected. So the sooner the better. If they wait until the very last minute, it's going to be more pain than everybody would experience if they do something now. So, hopefully Congress will do something sooner rather than later, but we'll have to wait and see how that plays out. Okay, looks like we have some questions. Excuse me. So, do you have the ability to model out the best Social Security strategies along with other sources of income or assets to give us a recommendation in the context of our whole financial situation? Yes, that's what I do every day, is help people understand that specifically for themselves. So yeah, we have lots of tools available, and that's what I do. That's how I help clients. So happy to help there. Okay, hey Nathan, this is awesome. Thanks for. Okay, what is that break-even point in your earlier analysis of working until 70 and the higher amount versus the lower amount for more years? So great question. This break-even analysis on an individual level is somewhere, depending on your full retirement age, is somewhere in the low 80s to mid 80s. So meaning if you're trying to weigh taking benefits early with waiting till full retirement age, it's your low 80s. If you're thinking about waiting till 70, it pushes that out a bit, and that break-even age is an important number to figure out. And when I run numbers for people, I can figure that out. When you throw in a spouse, it makes the break-even age a lot lower, and it also, chances of somebody living longer, it is higher because you have two people instead of one. So it's complicated, but somewhere in the low to mid 80s is kind of the break-even age for most people. Okay, next question. Sorry if I missed this, but how might one coordinate Roth conversions, distributions from pre-tax IRAs, 401k, payment of charitable contributions, etc., with Social Security benefits in order to avoid making Social Security taxable? Great question. Sometimes there is a window to do Roth conversions, and what a Roth conversion is taking your pre-tax retirement dollars that are going taxable when you pull them out. If you can convert those dollars or a portion of those dollars to Roth, and once it gets in the Roth account, the dollars are tax-free from that point, even the growth. And the downside is you have to take those conversion amounts into income in the year that you convert, and it's taxable. So just as an example, let's say somebody gets done working at 62. They decide it still makes sense to delay. So taking Social Security, they've got other savings they can live on or other income. There might be some lower income years for tax bracket purposes where they could do some of these Roth conversions and potentially get their future retirement distributions to be tax-free, it may be able to lower them to the point where their Social Security is not taxable. That's something I can figure out. I do it all the time when we're doing retirement planning, we're looking at that. to see if it makes sense. Roth conversions also might make sense if you have a low income year, even if you're not anywhere close to retirement age. If you have a low income year, you don't necessarily want to waste those low income tax brackets. And right now, we have historically low tax rates. I think most people would argue that taxes are probably going to come up in the future. And so taking advantage of the low tax rates, and if you have a low income year, that a Roth conversion makes a lot of sense. And you have to look at it individually and all the pieces together in order to make that determination. Yeah, that can make some sense, and I'm happy to help do that. Okay, can you go over the taxable income portion with an example? When you talked about the 50% and 85%, does this include investment income? So great question. It does. I'm going to go back to that slide. Okay. So notice this star down at the bottom. This is kind of the baseline for figuring out how much of your Social Security benefits are taxable. So combined income, it's your adjusted gross income, which would include all of your investment income, any wages earned, any business income earned, any rental income earned, any interest, dividends, total income, adjusted gross income. There are a few adjustments to that would reduce it. It's not total income. It is adjusted gross income from your tax return, plus non-taxable income. So if you have any, tax exempt dividends or interest, you have to add that back. And then you also have to add in half of your Social Security benefit income. That's how you figure out your combined income, which is the determining factor of where you fall in on this chart and how much of your benefits are taxable. So hopefully that makes sense there. Once again, if you're single and that combined income number is over 34,000, 85% of your benefits are taxable. And same thing if you're married, you get a little bit of an increase, 44,000. Once you're over those limits, then there's nothing you can really do to prevent Social Security from being taxable. Now, Utah also taxes Social Security income based on this same chart, because Utah follows the federal taxable income and it makes a few adjustments on deductions and things, but you start with adjusted gross income on your Utah tax return. Now, in the Utah legislature, there was a push to try to make Social Security benefits not taxable. It didn't get passed. And Utah is one of only a few states that taxes Social Security. There are several states that do not tax Social Security. So anyway, great question. Let's jump to, I think we have a few more here, and maybe not. I think that's all of our questions for now. If you've got one, I'm available for a few more minutes. So if you've got a question, type it in. Chances are somebody else has the same question. If it's more specific, feel free to reach out to me individually. Happy to jump on the phone or meet with you to answer your specific question. But if it's a general question or more general, the chances are somebody else has it as well. The last change, when we were talking about changes that Congress could make to shore up the system, one change that I don't like that has been talked about some is a means-based model. So, they would only pay Social Security benefits out to people who really needed it, and they would have some formula for figuring that out. I really hate that idea, because if somebody has prepared themselves well, saved well, made sacrifices while they were working to save for retirement, and now they get to retirement and they're penalized for doing the right thing, and somebody who didn't save at all gets benefits. I really don't like that idea. I would have a hard time if something like that happened. I think the easiest, most pain-free way is just a small increase in payroll taxes or a raise on the cap, in coordination with a delay and extending the full retirement ages. Looks like we just got a new question that came in. At what age do you suggest planning retirement and including Social Security in your calculations? It's a good question. I recommend at least looking at this from, as soon as you start working, because the sooner you start preparing for retirement, the easier it is. You don't have to set aside as much, and it just works better. So, and I do build in an estimate for Social Security, from the start. There, while you're working, there's an accumulation phase in your retirement, kind of in your lifetime, and you're working, you're accumulating wealth, you're saving, you're paying off debts, you're doing all the things. And then there's that transitionary period where you stop working and you got to figure out how you're going to replace your paychecks. And that's a really critical planning time. But even before, in that accumulation phase, you need to ask yourself, are you saving enough? Are you on track for retirement? When can you retire? Do all those things match up with your life goals? And so there's never really too early of a time to start planning. Things change and it gets a lot more critical closer to retirement, but planning early is always a good idea. All right, next question. What amount do you think someone should have in investments when retiring? So that's a great question. It's very individual. It depends on how much you want to spend in retirement. So kind of the old rule of thumb is that you can safely withdraw once somebody's retired. They can, if they have the right investment portfolio and plan in place for them, they can withdraw safely about 4 to 4.5% of what they've saved. And you can adjust that amount for inflation and take that amount safely over your expected lifetime and not run out of money. And so as an example, if you've saved $1 million, you can take somewhere between $40,000 to $45,000 a year, and and not worry about running out of money. A lot of factors go into that. You might be having a different investment strategy, but the right one, kind of the average, is 4 to 4.5%. There is some pressure that number might come down because while the stock market's had extremely good performance the last few years, everybody knows interest rates are very low. And so while interest rates are low, that means that expected returns on both interest-bearing investments and stocks is probably lower going forward than it has been historically. And so that 4 to 4.5% could be pushed down to 3.5%, but the old rule of thumb is 4 to 4.5%. And where that comes from, some people went back and studied retirement. If you were to retire at any point over the history of the stock market, which goes way back to like 1926, and they said what if you retired every month? If somebody retired and they analyzed that and they picked the worst possible time. So if somebody retired, right at the wrong time, right before 2008, they had super bad investment performance, what was the safe amount they could have taken out and not run out of money? And that's where that 4 to 4.5% comes from. So great question. All right. Looks like we're probably about out of time. Got about 2 more minutes. If you've got a last minute question, type it in and we'll try to answer it. And if not, everybody have a wonderful day and a wonderful rest of the week.